So, one of the problems that a lot of investors face is when they're looking to buy a commercial building or they're looking to buy an apartment complex, most of the lenders typically want 20, 25, or in some cases, even 30% down payment. We have a program today that we're going to be going over where you can buy a commercial building or a multifamily building with as little as 10% down payment. Yes, you heard it correctly. 10% down payment. To help us that, Veronica Geegan. She is a mortgage broker. Welcome back to the podcast, Veronica. How are you?
Great, thanks. Thanks for having me.
So, how is it possible when most lenders want to see 10, 20, 25, or 30% down that you're able to finance a commercial or a multifamily building with only 10% down?
I specialize in creative financing. So this is actually just another creative tool that I have for buyers that want to get into purchasing commercial, such as office space, retail, mixed use, industrial. It is a stated income type of program, and we would do seller carry. So our buyers would come in with 10%, and the seller would carry 20% on average. So as long as you have a seller that's willing to cooperate and can match the terms of the loan for the same amount, seller. So if I'm giving you a loan for 25 years, I need the seller to do the loan for 25 years too at XYZ rate that's negotiable between the two of you.
Got it. Okay. So basically, you're coming in with 10% down, and then you're getting an owner financing in second position for typically somewhere around 20%, which means the bank is lending about 70% of the value, basically.
That's correct. Yeah.
Okay. Now, when you say stated income, like what does that mean?
I'm used to the 2008 terms. Sorry. Stated income, we do not verify tax returns. No tax returns are needed. Stated income, we're going to actually, we don't even put the amount that you make. We care more about liquidity. We care more about the reserves that you have in your bank, which is equivalent to qualifying for this loan is 2 months bank statements.
And then what do you look for in the 2 month bank statement? Like how much reserve are we looking for?
We are looking for 6 months reserves plus a 10% down. Plus, we want to see the closing costs as well.
Okay, so 6 month reserves or whatever the PITI, the principal interest taxes and insurance would be, basically.
That's correct.
Fantastic. And then the 2 months bank statements, it just needs to show that 6 months for the last 2 months, basically.
Right, correct. We don't want to see a large deposit. Where did this come from? And it's inconsistent. We do want to see the consistency there.
Got it. Okay. And then how long of an amortization is this? And is this like how long do they have a balloon or is it 25, 30 year? What does that look like?
It's a 25-year term, and there is a 5-year prepay, diminishing prepay, meaning it goes lower and lower, lower each year. So the first year it's 5%. Next year is 4% of the if you want to pay off the loan. So there is a 5-year diminishing prepay.
Got it. So it goes five, four, three, two, one, and then it gets eliminated, which that's very common in commercial financing, basically, like a lot of the commercial, and it's
Absolutely.
even very common in the DSCR loans as well, too, right? Or in some
Very
capacity.
common.
Yeah.
Yes, absolutely.
Okay. And then is this how much higher than market is the interest rate on this, or how comparable to whatever market is?
So typically we're at 1.5 to 2% higher than the conventional rates, possibly even a little bit more. I wouldn't go as far as 3%. No, I would not. I would not. So if you're getting a average of 7, I'm going to be at 9. That's a safe number.
Who's typically doing this type of loan?
I see a lot of business owners that are trying to buy the buildings that they've been there for 20 years. They know the owner, nail shops, clothing stores, say retail spaces. They have their shop there. I had an auto mechanic body. They were renting there for 15 years, and the owner's like, I just want to get rid of it. Guy says, I don't have enough. It's like, well, just pay me money on the difference. So he's carrying a second. This was on an auto body shop.
Got it. And this is perfect for them because they're cashing out on 70% of the equity, basically. And no, actually 80% of the equity, basically, and only financing the 20%, basically. You mentioned off camera something about a debt coverage ratio. How is that different between the multifamily buildings and commercial buildings as well, too? And what is a debt coverage ratio, if you can go over that really quickly?
Debt coverage ratio is, in simple terms, is the payment versus the collected rents. So we'd like to see 1 to 1 is the typical norm. So we have to see that at least the rents are covering the payments. That's it. On this program, there is no minimum DSCR, debt service coverage ratio. You don't have that. You will see this very common on a multifamily or the renowned program, the DSCR loan. That's all it is the rents have to cover the payments. This program, we don't look at that. We don't look at that.
Got it. So for commercial, debt coverage ratio doesn't really matter, but for multifamily, it's got to be at least a 1 to 1 basically ratio, and then obviously have 6 months reserves on the program as well too.
Yes.
Got it. Okay. Is there anything else that we missed on this program?
Not this one. Not this one.
Absolutely. Okay, great. So where can people find you if they wanted to get more information on this program?
Closewithveronica.com, closewithveronica@gmail, and closewithveronica on Instagram.
Fantastic. Okay. So I do want to say thank you, Veronica, for taking the time to be on the podcast. To our viewers, if you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode will be helpful to somebody, make sure to hit that share button. Thank you again, Veronica. And to our viewers, until next time.